It's not for the faint-hearted. It's not your grandmother's mutual fund, and meaning that you'll have a more variance than possibly what you're accustomed to, but also the potential for larger profits.
Today, we will talk about the very exciting zero DTE options trade strategy on SPX with big profit potential. My guest is Dale Perryman, who has had tremendous success with his way of selling iron flies. Welcome, Dale.
Thank you very much, John.
Give me the elevator pitch on this iron flies strategy you are doing.
Elevator pitch, it's a four-legged trade, primarily selling at the money on SPX with very specific opening rules and closing rules to keep your losses manageable, which gives you a chance to have a big win every day. Call ourselves the fly catchers with the objective of catching the close price relatively close to one of 1 to 4 flies that we'll have on at the end of the day.
And it's not a strategy for the faint-hearted, I understand. It's a bit up and down.
It's not your grandmother's mutual fund, and meaning that you'll have more variance than possibly what you're accustomed to, but also the potential for larger profits.
Dale, tell me a little bit about you as an option trader.
I bought my first mutual fund in 1988, and I had to drive to the library to research it. I was a buy and hold guy until about 2008, and I saw my portfolio going down. I talked to a friend of mine who worked at a hedge fund, and he said, "What are you doing to hedge?" And I said, "What's a hedge?" At that moment, I learned about options and I began to sell covered calls. I did that for enough years on Apple, where my cost basis was about minus $40 a share. Then I found a tasty trade, opened up my game, started selling strangles, etc., and have tried a number of different strategies over the years. Today, one of my favorite strategies is iron flies, and that's where I've landed. I manage a number of different accounts, primarily for some friends and family, running a small hedge fund, trading multiple accounts.
So let's start with the basic. What is an iron fly?
An iron fly is a four-legged trade. You're selling a put, selling a call close to or at the money, and then you have two wings, which are anywhere from 20 to 50 points away. That is essentially an iron fly, and we're doing it on SPX.
And we have an example here to visualize what an iron fly looks like.
And as you see on this graph, the heaviest profit potential is at the peak where SPX is closing close to that peak, and you see your max losses on the edges.
And why have you chosen SPX for this strategy?
Well, SPX cash settles, which basically means at the end of the day, it settles to cash. So it's impossible to get assigned long SPX or short SPX.
But I guess you could also do this strategy on XSP, which is kind of a mini version of SPX, right?
You could trade it on XSP. For every gimme, there's a gotcha. The gotcha is XSP doesn't quite have the same liquidity. Liquidity is the spread between the bid and ask. So there's not as much volume in XSP as there is in SPX.
Take us through how you trade this strategy with entry and exits.
Every day around between 9:30 a.m. Central Time and 10 a.m. Central Time, I'll do a roll call. Who's ready to fly? Are we at ready or wait? Usually we try to avoid significant news events. If something's about to happen, we might wait a little longer. But it's usually around 10 a.m. that we put our first fly on, and we're looking to trade it very close to at the money. Now there's times where we'll need to split the difference. So if something is trading like in between 15 and 20, you're going to have to make a decision about whether or not you go with the 15s or the 20s. We'll usually wait for price to break the tie, so to speak. But our attempt on the very first one is to go very close, if not at the money.
What are the rules for your second trade?
Well, the very first one determines our next action. So it all depends upon, John, how much you collect for that first fly.
Okay.
So we've collected anywhere from $13 per contract to $27
Hmm.
per contract. I believe on Friday, our first one was around $14 because right now we're at a very low VIX environment, a low volatility. So we're not getting as much premium as we used to.
What are the rules?
In essence, anytime you collect less than $15, our next ad will be a plus or minus 7 with an ad at 10. If we've collected over $15, between $15 to $19, our next ad would be plus or minus 10 with an ad 15 apart.
So let me try to understand this. If the first iron fly is sold at, let's say, 6,000, and you have collected less than 15, you will wait till the price gets up to 6,007 or down to 5,093. At that time, you would add a new fly that is either 6,010 or 59,090. Is that correct?
Exactly. So it's probably better to view a visual or see that in action in order to better understand it. But essentially, the essence is the price that you collect for your first fly, it determines your overall strategy.
And then how long do you keep adding new flies?
Well, we will always have one or two flies on until about 12:30 Central Time. And at that time, we begin to load up the boat. We don't want to load up the boat until probably 2 hours before close.
And what are the rules for getting out of them? Do you have any kind of stop loss or other rules for when you close them?
It's not typical to what most people think about stop losses, but it's essentially exiting a fly anytime it gets to 90 to 100% loss at expiration. For example, if you sold something at 6,000 and it went to 6,010 and you collected $10 for it, you'd begin to cut your losses on that one.
Okay.
If you were at 6,000 and you collected $10 and it gets down to 59.90, then you'd begin to cut your losses on that one. So
Okay.
it's anywhere from 90% to 100% break even at expiration.
Okay. And how wide are your wings?
Well, at the beginning of the day, my maximum wings are 50. Throughout the day, I will adjust that wing width. The sweet spot is around 40 cents for a long.
Okay.
There's no need to go wider. If you've got to 40 cents, taking it to 30 cents, 10 extra points or 5 extra points of risk is
Mhm.
not really worth it. So it's kind of a risk reward in adjusting the width of your wings. It'll go from 50 to 40 to 30. The last 30 minutes will probably be 20 wide if you have additional ads.
And if you trade this strategy with one contract for each iron fly, how much buying power would you need to trade this strategy on a
Good
typical
question.
day?
Good question. Let me start with how you calculate the maximum buying power. So you start with the width of your wings. In this case, if it's 50 minus the credit you collected. So let's say you collected $15. 50 minus 15 would be 35. If you're trading one contract, your maximum loss would be $3,500. So that's, you've got one fly, you've used $3,500 in buying power. Now, the question might be, what should you budget for the entire amount of wings you might trade that day? A comfort level is anywhere from 12,500 to $20,000 per contract traded is a comfortable range that would accommodate anywhere from three to on large premium days up to 4 or 5 flies.
All right. I It takes a bit time to grasp the rules that you are trading this with. So I thought let's look at one specific day and how you traded then, and let's bring that up. This is the graph from Friday, January 24, how the SPX was developing throughout the day in the 5-minute intervals. So anything you would say about this day before we go into the trades?
Well, a lot of times the market will open at 8:30 a.m. Central Time, and we typically have a considerable amount of volatility for the first hour and a half. We like to bypass that. So sometime around 9:30 a.m. to 10 a.m., we're looking at our first fly. On Friday, it happened to be around 10 a.m. And we're trading at 61.15. So that was the first iron fly we put on at 61.15.
If anyone wonders about the times on this graph, the times below are actually the time zone in Norway, where I live.
Gotcha. So as you can see, price began to move up. I believe on that first fly, we collected around $14. Our first rule was at plus or minus 7. We would have an ad at 10 away. And so as you see, price moves up. When it gets to 61.22, we added the 61.25s. So now we're in
Like
two
that.
flies, the 61.15s and the 61.25s.
Hmm. And then the next trade is closing that one.
Yeah, what happened is the price moved down. We gave it about a 1 to 3 point tolerance on the 25s. Price gets down to about 61.14, 61.13, and we close the 61.25. So now we're just in the 61.15s.
And this would be around the break-even zone for this trade, I guess.
Yeah, the 61.25s was close to a break even, if not a small loss.
And then the next step you are doing.
Market continues to go down. We're now compromising. We went to plus or minus 2.5 with an ad at 5. So the price goes down to 61.1250 and we add the 61.15s. So now we're in the 61.15s and the 61.10s.
And then you add another one.
And then the price continues to go down. So it goes down to 61.0750 and we'd add the 61.05. So now we've got the 5s, the 10s, and the 15s.
And the market keeps changing.
The market keeps going down. We've collected enough on the 61.15s. I might have misspoke earlier. We might have collected as much as $16 for those 61.15s. So give it a little bit of tolerance. Now we've got the double O's, the 5s, the 10s, and the 15s.
4 flies open. Is that typical at this time of the day?
Typical is anywhere from 3 to 5 flies, depending upon how much you collected. For your first one, if you've collected over $15, the most you would have on at any one time would be 4. If you've collected less than 15, the most you have on is 3. So essentially, as premium begins to dry up, we might move from a maximum of 4 flies to a maximum of 3 because you're collecting less premium.
And that's what's happening here. You are a bit later, close as the market continues to go down. You are closing the 61.15.
Yeah, so the price goes down at some point. We've passed our tolerance level for the 61.15s and we close the 61.15s. So now we're just in the double O's, the 5s, and the 10s.
And let's take one more step.
So now price continues to go down. We've hit our tolerance, and so we exit the 61.10s. So now we're just in the double O's and the 5s. Now price, as it moves down to 60.9750, we add the 60.95. So now we're in the 95s, the double O's, and the O5s.
And then one more is closed.
And then we hit our exit for the 61.05. So we're in the 95s and double O's.
But you add one more.
And as price gets down to 92.50, we add the 60.90. So now we're in the 90, 95s, and double O's.
And that is how it looks at the end of the day, right?
Yep. And it closed at the end of the day. I think it was 61.01.
Yes.
So yeah, we've been close. I think our ideal close there would have been 60.95. We went slightly outside the range, but it was still a profitable day.
Here are your profits for the day, right? And you had a profit of $206
Yep.
per contract that
That's
was traded this day.
I would classify that as a small win.
All right. You need to be on alert trading this strategy. Be next to your computer and follow the market very closely. Isn't that so?
Yes, John, it's definitely not a set it and forget it and go to the supermarket type of trade.
You said that you're trading in a group. Tell me about that.
We trade every day in Zoom, and we have what's called a captain's log. The analogy would be to Star Trek, where we're always within the group. There's a central focus point where we know what flies we're in, we know the next add or drop, and we know the specific price based upon that captain's log. It helps to guide us. Trading can be a lonely sport, and it allows some camaraderie. We can celebrate together when we have a winning day. We can commiserate when we have a losing day, and kind of group therapy, so to speak. It's definitely a group where we learn from each other. And what I find is that you get a group of smart people together, and it's more valuable than the smartest consultants.
And I'm sure people are a bit curious about the results, and we will look at them now because it is a bit of a roller coaster, although it has been very profitable for you. But this is the results graph that you have had since you started trading this in 2023, was it?
Yes, and it's in 3 months it'll be our 2-year anniversary.
So, how would you comment on this result graph?
As you can see, there are some significant times of drawdowns. So what I say is you live by the sword, you die by the sword. And what I mean by that is at times where you see my biggest up move and my biggest down move, it's as a result of a growth that I had grown the number of contracts. So as you grow the number of contracts, you can expect bigger swings up and bigger swings down. If a person wants to have smaller down moves, you could just trade smaller. Ideally, if you were to put a kayak into the ocean, you would experience a lot of waves. Ideally, put a kayak on top of an aircraft carrier and you wouldn't feel any wave at all. And so I guess having a larger account and trading this very small and reinvesting the proceeds back into the strategy, I think is a healthy growth rate. So I think as you see, I've gone kind of from 0 to 1.5 million over this time period with a high of about 2 million.
It's very impressive. And you said that this strategy constitutes about 65% of your profits. But I also know that you trade a number of other strategies, some of them much more conservative. One of them is poor man's covered call that you explained very well in a previous video. We will put a link to that video in the description. So how much of your trading capital are you allocating to this strategy?
When I started, it was 20% of my buying power allocated to this strategy. And I'm a fan of reinvesting the profits of this strategy back into this strategy. So it might grow from 20% of your buying power to perhaps 30% of your buying power. But I'd say that's a comfortable amount in a portfolio.
Can you sum up the most important risk management rules you follow with this strategy?
Yeah. Follow the rules, stay on the reservation, What is the reservation? The reservation is where we've been for some period of time, and we feel comfortable that we know what the numbers are going to be. If you choose to go off the reservation, it can be dangerous. You might do better than we do that day, or you might do worse, but we don't really know what might be out there if you're choosing to go off on your own. So while I encourage experimentation and little bets, don't go too crazy with it because you're not quite sure what's out there.
How would you compare this to other ironfly strategies people are trading? I know some are, for instance, putting on ironflies early in the morning and taking profit at 10-15% and having a stop loss, for instance. How would you compare these different styles of ironflies?
Well, well, our strategy is really capitalizing upon what the theta decay that occurs in the last hour. And while we call it power hour, which is the last hour from 2 o'clock p.m. to 3 o'clock p.m., a lot of crazy things can happen, but there's also a lot of opportunity. There's a lot of theta decay. Many times you can double your profits in the last hour from the entire day, or the market could like snatch it away. So there's a Chinese symbol that includes danger and opportunity. In any crisis, there's danger and opportunity. We believe there's so much opportunity in the last hour that will fly into the close. These other trades many times won't go near that last hour because it's so dangerous. I traded one of those other strategies, very good strategy. And if you don't have time to babysit it, you could take a 12% profit target or a 30% stop loss. It's a pretty good strategy. It has a 70% win rate. So it's a winning strategy to do that with iron flies, but you miss the chance for the bigger wins.
Let's look at the risk profile of this strategy. Where would you put it on a scale from 1 being very low risk and 10 being very high risk? Where would you put this strategy?
And I assume that you're asking me against all of the available, including, people who are buying straight out calls way out of the money. I mean, would be a high risk, low probability, I would think, gambling strategy. So if you add them into the equation, I think this strategy uh, would be at a 6 or 1 to 10 scale. If 1 is just buying T-bills and 10 is gambling by selling a call or put way out of the money.
What is the worst that can happen with a strategy?
The worst thing that could happen is that you have a really bad day and you are following the rules and you have an $8,000 per contract loss. And those days will happen. Worse than that is you completely go off the reservation. You don't follow the rules. In that case, you could take a max loss. In 2 years, I could count on one hand how many times I've taken max losses. And that's in thousands of iron flies. All of those on one hand was due to some human error.
When you close your trades, one iron fly, will you close the whole iron fly, all 4 legs in one operation, or will you do the shorts first and then the longs, or split it up?
I would say 99% of the time I close all 4 legs. Now I'm experimenting with a larger account where I buy a set of wings in a block, and the rest of the day I just trade the shorts. If you've got a large amount of buying power in a larger account and you don't care as much about your buying power, you can do that. And I think you can have a strategy that's slightly more profitable. It will be more dangerous because you need to be on top of it because your protection is wider.
So let's sum up. Who is this strategy suited for, and who should not try this strategy?
You should not try it if you don't have time to manage it. I think it's suitable for a person that has interest in being around. Now, you don't have to do it every day. I mean, you could just do it on the days where you are around and you're available. So who's it not for? It's not for someone that doesn't have that ability um, to manage it and to watch it throughout the day.
And I guess you should also be comfortable with the large drawdowns you have seen.
Yeah, so comfortable with the drawdowns. And I really think in order to manage some of those larger drawdowns, you need to give yourself a chance for the big wins. What does that mean? That means if you're always taking the money and run, like a small win, I'm happy with $500. I'm just going to take this money and close everything. Well, that's fine and dandy, but what's going to happen when you're down 2,000, 3,000, 4,000? You really need to give yourself a chance for those big wins in order to offset some of your larger losses to make the numbers work.
Where can people learn more about how to trade this strategy?
Well, if you're on Discord, you could join our Discord at TradeDiff. We do have some um, security in place to make sure that people are legit. You could join us on our daily Zoom calls. You could find me on YouTube where you can watch a video of a description of iron flies or contact me through private message, through comments on YouTube.
Dale Perryman, thank you very much for once more sharing one of your strategies with us.
Well, my pleasure.